Welcome to the monthly market report for October of 2021. Over the next 20 minutes or so, I'm going to break down some of the biggest topics in real estate today to give you those topics and the perspective that you need to be knowledgeable in your real estate market. All right, so I'm going to start today with an update on pricing, and I want to begin with this quote from Bill McBride from Calculated Risk. It says, "My sense is the Case-Shiller national growth rate of 19.7% is probably close to a peak, and year-over-year price increases will slow later this year." So what does this mean? So as a buyer or seller, you're out there seeing things like prices have peaked, price increases will slow later this year. It sparks questions and uncertainty. And what I'm going to bring for you today is some context and clarity on what's happening with prices and what you can expect moving forward. Okay, so let's start with a look at July of 2021 year-over-year home price appreciation. This is the latest data that we have. And FHFA is showing that home prices have appreciated by 19.2%. CoreLogic is showing year-over-year appreciation at 18%, and the S&P Case-Shiller Index is showing 19.7%. So this is dramatic. This is incredible home price appreciation. And as we look at this, it's largely due, as we've been saying for months now, to supply and demand. So we simply have not had enough homes on the market for the demand from buyers, and that causes the price to rise. So let's take a look at what this looks like across the country. So this is our price appreciation map year over year for Q2 of 2021. Now, what you can see here is that the states in red have over 20% appreciation over the past year, and as a whole, 17.4% for the United States, but you can really see how it breaks down state by state here. Now, what we're starting to see is the forecast for going forward and what experts are projecting going forward. And that's where I want to really clarify the conversation. And I'm going to start with this quote from Ivy Zelman. This quote says, "Closings are set to decline roughly 10% year over year in the second half of 2021, and home price appreciation is on the cusp of flipping to a decelerating trend." So let's break down what this means exactly, and I really want to hang on the word decelerating for a moment because that's where we really need to provide this clarity. So when people see the word decelerating, they're immediately going to think depreciation, but please hear me loud and clear when I say that experts are not projecting depreciation at all. What experts are actually projecting is increased home appreciation just at a slower or more moderate rate than it has been. So that's where decelerating comes into the conversation. And it's really critical to understand the difference between depreciation and decelerating trends. So again, not expecting depreciation, but we're expecting appreciation to slow down, to decelerate. So let me show you what that means. This is the estimated home price performance, and it's from the Home Price Expectations Survey. What we can see right here is that through the rest of 2021, home prices are expected to continue to increase at 11.74%. So that means continued appreciation. And what we also see is that it's not as massive as what we've seen over the past year with that 18 to 19, almost 20% appreciation. So a much more moderate pace than the rest of this year. And going forward, as we look at 2022, 2023, and beyond, we're seeing continued appreciation, but at that much more moderate pace, 5.82% for 2022 and so forth. So what that means is that home prices are not expected to decline at all. They're just expected to appreciate at a slower pace. So let me break that down a little bit further. This is the expected home value change, and this also comes from the Home Price Expectations Survey. So you saw that 11.74% appreciation for 2021, and if we average out the 5 years that I just showed you on the previous slide, the annual average through 2025 is about 5.7%. Now, we know that the historical norm for home price appreciation has been 3.8% per year, but that historical norm has even bumped to 4.1% due to the price appreciation over the past year. So even the historical norm is climbing, and then cumulatively through 2025, home prices are expected to appreciate 31.8% if we add up to the next 5 years. So home prices are definitely still rising, again, due to supply and demand, and they're not expected to decline. And so what's really important is that, we help you as buyers in particular, understand that buying now before home prices continue to accelerate is really important. So, getting in now while mortgage rates are still low, we know that mortgage rates are going to tick back up. We know that home prices are expected to continue to rise. So buying now, if you can find a home, it's really mission critical to that long-term wealth advantage. And, we always say, if you could go back 10 years and do it again, would you buy another home? Because the value has increased exponentially, and most people say, yeah, I'd buy a home again, and I'd probably buy 2 or 3 of them as well. So that's the message that I really want to share with you all, is that home prices are not expected to depreciate. They're just going to be appreciating at a decelerating pace. That's critical to understand. All right, so the other question that a lot of people are asking about right now is, what about the fourth quarter? What is this year going to end up looking like? And normally about this time, we would be bringing on the monthly market report, your forecast and things looking to the fourth quarter. And it's sort of hard for forecasters to go out and make any type of assumptions on what's going to happen because of the last year and a half in the pandemic and how unusual that's been. So for the next couple of minutes, I'm going to try to explain the position the forecasters are in and show you really what we need to be looking at. And then we're going to wrap up and talk about interest rates, probably one of the biggest issues right now that people are looking at, the rising interest rates. And we'll give you all the information you need to know on that, and then we'll wrap up with these sales stats. Okay, so let's start off here. Diana from CNBC says, fall is usually the start of the slower season for the housing market, but nothing is usual in today's pandemic-driven housing market. Potential home buyers are seeing a slight rise in inventory, consequently rushing back into the fray. Now, I don't know if they're rushing back into the fray, but certainly people are noticing that. So she goes on to say, mortgage applications to purchase a home jumped 7% last week from the previous week. And that's the highest level since April of this year. So people are starting to say, hey, we want to get back in. We're seeing rising inventory levels, and forecasters are struggling with how do we forecast the remainder of this year because it is so atypical. And the bottom line is that home sales are very different to forecast right now because of these 3 lines on the screen here. And what this is annualized home sales from 2019, 2020, and the green line is 2021. And what you see there is that 2020 was nothing like a normal year, which we saw in 2019. So if we want to go back to a normal year, we have to go back to 2019 and look and say, okay, what did that year look like? Because we know what the pandemic brought. It brought this orange line here on the screen, the dip down, the rise back up, and we sort of did double duty in the second half of last year, and we packed all of the business into a short amount of time after the lockdown. So many people, because of low interest rates, because of the needs of home changing, because of all of the things that we've talked about on the monthly market report in the past couple of months, people rushed back into the market. And it became this abnormal year. We sold more homes last year than we've sold before, and we all know the story of that. So let me break down why let me break down why it seems like things are slowing down. And this is probably the best visual that I could give you of why that seems that way. So remember the front half of the year, we talked about all the things that we were going to see, from inventory to annualized home sales to so many things that were going to be up year over year because we were in lockdown. A lot of people took their homes off the market, the business slowed, the economy slowed back in the spring of 2020. And then this year, the spring of 2021, we were over that, but simply because things were in lockdown. Well, we're about to enter a time in the latter half of the reporting season, the end of summer into fall and into winter, where we packed a ton of business, and we're going to be below that orange line. And folks are going to say, hey, we're down year over year, and you're already seeing that happen. You're down in home sales, and foreclosures are rising. Now, we've talked about that issue extensively, but just realize that's kind of the situation where we're heading into. But the reality is we're beating 2019, which was a very, very good year in real estate and the last normal year that we can look at. And you see right here so when I isolated 2019 and 2021 here on the screen, you can see right where we're at. And so the reality is we saw 2019 being one of the best years in the last 10 years in real estate, and we're ahead of that right now. So this is a look at existing home sales going all the way back to 2021. And you can see it right here, 2019, the best year except for 2017. One year was a little bit better in existing home sales, but we're doing very, very good. So if I take things back to where we were just a moment ago, home sales were very, very difficult to forecast because forecasters don't know what's going to happen. Now, in a minute, I'm going to talk about what I believe we really need to be talking about. But the truth right now is that they're looking at this and they're going, okay, there are a couple different options. So we're going to come through here and level out, or be in the middle of where we were in 2020 and above where we were in 2019. And what you're going to see happen is you're going to see half of the headlines say, hey, we're ahead of where we were in 2019, and the other half are going to say, we're down year over year. And there's going to be some confusion with that. And this is really the situation that we're in right now, where we packed so much business in the last year, where we're going to be below that, no doubt. But we're going to be ahead of a very, very normal year in 2019. And that's the quandary that these forecasters are in right now. They don't know what to expect because things have been so unusual for the past couple of years. Now, one thing that I do think we need to look at, if you want to know what the future of real estate market is going to be, we want to look at active listings. And this is a look at the active monthly listings counts of 2017, 2018, and 2019. Remember, I said 2019 was the last normal year we saw, so we're going back 3 years here. And what typically happens in our business is listings peak sometime in the fall and then they drop off. And we repeat this cycle again. You can see here for the last 3 years before we got into the pandemic, 2017, 2018, 2019, listings peaking there in the fall and then dropping off before starting over a new year. And then we know after 2019, that brought 2020. So in 2020, monthly listing counts peaked in April, as you can see here. They peaked and then everybody rushed back into the fray, and then we started to dwindle listings all across the country. You can see that on the screen here. Now, this sets up a challenge moving forward, as always has been, closing the gap. As those listings drop, sales shot up. Remember how we just looked at that graphic. So listings are going down, sales are shooting up, and the big question becomes now, when will listings peak this year? And so if we saw listings drop last year, We toughed it out here in the front part of the year, less listings on the market than we've ever seen. The question is now, when will they peak? And there are three scenarios. So one, let me just bring this up here. One is they're going to continue to grow, and we're going to eclipse where we were in 2020, and that's going to give us a little bit of relief in the frenzy in the market and pricing relief as well. There's a second option that just flattens out, and we continue on here and probably intersect where we were in 2020 at some point. And then there's the third option where listings peak and then begin to dwindle. If the third option happens, that's where you will see more price appreciation. It's upward pressure on prices, and that will be the story. But I think that there are three reasons why we will see continued listings going into this fall. That's what I believe. First of all, pent-up seller demand. No doubt homeowners are going to be more comfortable putting their homes on the market as more people get backstage. They feel comfortable from a health perspective doing so. Number two, new construction is starting to take off. Builders are realizing the opportunity, trying to build as much as they can. Now, this past year, they've had a lot of headwinds in front of them with material costs, specifically lumber, all the things they need to build a home outside of lumber, all the labor costs, the labor shortages have been hard for builders, but they're starting to turn the corner and see the opportunity in this market. And the third reason, the end of forbearance will create new listings. Now, we've gone over this a few times in the monthly market report, so we're not going to, we're not going to create this wave of foreclosures, but it will create a time in the market for people to say, you know what, we can't afford this home any longer. We're going to have to put the house on the market. So I think there's a lot of reasons right now that we'll see that listing number begin or continue to climb. But at the end of the day, we're going to have to watch it. If we really want to know what's going to happen in this question of what's the market going to do, we have to watch listings, and we have to be diligent about getting out there and obtaining those listings as well. Now, the other big story right now is interest rates. No doubt we're starting to see some movement in interest rates for a lot of different reasons, but I want to talk about that for just a minute. Certainly not here today to say the sky is falling and interest rates are about to shoot up, but I want to give you a look at what interest rates are doing so that you can be educated on this topic. Okay, so first a quote here from Ali Wolf. The single biggest risk to housing is rising mortgage rates. It's a real possibility that the next year, and this could bring prices down further. Other economic, financial, and confidence challenges could also result in a drop or flattening of home prices. But a drop or flattening in home prices is a far cry from the crash we saw during the Great Recession. So Ali Wolf saying, you know what, the biggest issue, the frenzy in the housing market could be rising interest rates. It's going to be more expensive for people to borrow. Right now, the 30-year fixed just jumped above 3%. It's sort of crazy that we're talking about a rising interest rate environment and we had, an average 30-year fix of just over 3%. So you see right here 3.01% as recorded by Freddie Mac on their weekly survey, and that jumped up as they're starting to see indications of the Fed saying we're going to taper soon. This is the word they've used. So, another quote from Freddie Mac. Many factors led to this increase, including the Federal Reserve communicating that it will taper its support to the capital markets. So that's the soon element. The Fed came out and said, we've been buying mortgage-backed securities. Now we're going to start to taper that. We're going to start to pull back on that. And we'll do that coming up, the market starting to price that in. So he goes on to say the broadening of inflation and emerging energy supply shortages, which compound other material and labor shortages. So the issue right here is the economy is recovering. not recovering as quickly as what they would like to see, but the Fed saying, hey, we're going to start to taper on what we're buying in the mortgage market. So that's causing interest rates to go up. Now, I think that's important that we realize we're in a great environment right now. It will cost more to buy as homes appreciate going into the next year, as interest rates rise going into the next year, but nobody's calling for this sharp rate in spikes at all. Or I'm sorry, sharp spike in rates. As a matter of fact, here are the latest projections in interest rates. This is from Fannie, Freddie, MBA, and NAR. And you can see somewhere around the middle to the third quarter of the next year about being 3.5%. So, you know, we're just right about 3% right now, 3.5% if we want a visual for this. We've got the Freddie Mac visual right here. So you see the drop in rates through the pandemic and starting to inch back up. Freddie Mac saying that by the third quarter, being around 3.7%. So I don't know. I'm not here today to say that this is where interest rates are going to be. I don't think it's going to be 4%, and probably not 3.25%, somewhere in the middle, maybe call it 3.5, maybe a little bit more than that, but no doubt interest rates are going to rise. So in this example here, I've got a $400,000 loan that somebody may obtain to buy a home. If they look at 2 to 3 quarters, which we've been at for quite a while, that payment is about $1,633. So if we go up to 3%, it rises to $1,686, right above that. And if the interest rates go up in the next year, knocking on 4%, the rate now allows you to buy a lot less home. And I don't want to convince anybody to do anything that they don't want to do, but I do want to show everyone that as prices rise, as rates rise, it's going to cost more in the long run to buy a home, and certainly to finance that home as well. As I wrap up the monthly market report, a couple of things I want to mention. One, DS News came out with this quote. I thought it was really good. They said homeownership is one of the fundamental keys to accumulating wealth in America. Hence why it has been integrally linked to achieving the American dream. Not only can owning a home provide a roof over your head and a secure place to live, but because mortgage payments generally remain fixed while rents may rise over time, a home can be a very effective hedge against inflation. So inflation's being talked about a lot right now. And a home is a super effective hedge against that inflation because you have a fixed payment. So the quote goes on to say, together these features can give homeowners an enormous advantage over renters when it comes to accumulating wealth. The opportunity for homeownership not only is a shelter, we know the financial, non-financial benefits of homeownership, but it helps people build wealth all across the country. So with people right now seeing rising interest rates, seeing prices go up, many people are saying, you know what, I don't really want to buy right now at the top of the market. And I think what people fail to miss in this is that forecasters are not calling for depreciation in the market. I think there may be some deceleration of prices, meaning we're not going to stay at a price point, that the appreciation point that we've been at, but we're going to see less appreciation, but definitely not depreciation. So the home price expectation survey just came out. If you look at a $350,000 home over the next 5 years, the purchaser of that home stands to gain just over $111,000 in gained equity based on the forecast appreciations for the next 5 years. And when people see that, this, they're thinking that, why would I buy at the top of the market? They miss this piece. They miss this piece right here, and they go, wow, they're surprised. But right now, the bottom line is homes across this country are underbuilt. We've talked about that, undersupplies, and that's not going to be fixed overnight. All right, so we are going to wrap up with sales stats. So let's start with Philadelphia County. You'll see units listed was a little over 2,500, units sold just about 1,600. Median listed price is $278K, median sold price was $260K. For Bucks County, there were 802 units listed, 801 units were sold. The listed median price was $400,000, the sold median price was $389,000. And for Montgomery County, we have almost 1,200 units listed, about 1,131 units sold. Both the listed and sold median price is $370,000. And finishing up with Delco, 820 units were listed, 709 units sold. Listed median price is $275,000, and the sold median price was $262,500. All right. So, as always, the monthly market report is intended to give you everything you need to know, the insights, the data, and all the information that you need at your fingertips so that you can be educated in the market. I hope this was helpful. I'll see you again next month.